Michael Arone is the chief investment strategist over at State Street Investment Management, which has about $5 trillion in assets under management. Massive ETF provider as well out there. Thank you so much for joining us here. Let's go through what separates cautiously optimistic from uncomfortably bullish.
So uncomfortably bullish, I think we just were watching the president, and he seemed really happy. And we know people love him or hate him, put that aside. But when we look at this, there's a lot for investors to be happy about. So we're going to get fiscal stimulus from the One Big Beautiful Bill Act. The economy is already expanding. You get monetary policy easing. That's going to help. You mentioned we're kicking off earnings season. Those earnings numbers are going to be great. We're going to have double-digit earnings growth again. The consumer has been resilient and will be supported by tax refunds and also by the World Cup and celebrating the 250th anniversary of the Declaration of Independence. Sprinkle in a little deregulation and continued AI spending. Those are the ingredients to be bullish, Dom.
Well, but uncomfortably so, right?
Well, because what you're almost saying is we've had such a good run. You know, and it feels a little crazy to say after all the double-digit gains we've had back-to-back, it's going to keep going.
I think there's two things that contribute to my discomfort. First is that valuations are certainly higher than normal, but we know they're a poor predictor of short-term price performance. And valuations are high, credit spreads are tight. Most measures of market volatility are fairly complacent. So the margin for error is small, and the risk of disappointment is big. And I think you're seeing that, right? Today, J.P. Morgan blew out the top and bottom line numbers, yet given the news cycle, they're actually down a little bit on the day.
Do you think they're down because of the news cycle or because of the earnings?
I don't think they're down because of the earnings at all. I think they're down more because of the potential to push back on policy around credit cards and capping interest rates from that perspective, or credit card rates. The other part of this certainly is kind of the heavy hand of the Trump administration as they turn to a more populist policy. Now, again, this is kind of a natural transition. And from my perspective, whether it's kind of, you can see it when they announced preventing defense companies from doing share buybacks and dividends, the stocks were down. That very same night, given the policy, kind of the objective of increasing the defense budget so massively, the stocks rallied. And you could see this volatility. So, Kelly, for me, the big takeaway this year is midterm election years tend to be more volatile. The average intraday decline in a midterm election year is 19%.
Wow.
In the other 3 years, it's 12%. So you should expect more volatility, but that doesn't mean we'll end up not in a good spot.
Right. We've heard the May through, I guess, November period is often the weakest and the sell in May. But, you know, can we all sort of say with such confidence, well, it probably will get weak in the middle, heading up to midterms, and then we rally at the end? I mean, can it be so easy as just to say that's probably what's likely to happen? Or is that the fact that that is the most likely playbook that everyone can see tells us that something very different could take place?
Well, I think that the headline, certainly as the year was concluding, the VIX closed below 14 for the first time in more than a year.
Wow.
And I know being at home, maybe you all were celebrating the holidays somewhere, and I was reading, and I was like, boy, that
just celebrating the VIX.
Yeah, I was keeping an eye on the VIX. And, Tom, it just seemed like it was so low, too
cheap
calm.
Insurance is what I've heard it called now.
So
right?
Seeing it kind of tick up here, given the headlines, given the potential for the Supreme Court announcement tomorrow, given some of the policy interference, for lack of a better word, I expect this to inject more volatility. But overall, the ingredients for this bull market remain pretty strong. I'll give you quickly, there's been 4 times since 1926 where we've had 3 consecutive years of 15% returns on the S&P and higher. So in those 4 times, only once did the 4th year decline. That was 2022. In the other 3, Kelly, we went on to have 15% or higher returns in that 4th year. 1998 was the last one. This reminds me a lot of 1998.
Right, but so in terms of 1998, if we're going to juxtapose it or kind of compare it to that, sentiment was very different in 1998 than arguably it is right now. So from your standpoint, is there enough consumer and investor sentiment to keep this momentum going, or there is a case to be made anyway that people are becoming a little bit more cautious because they see what's happening around and they say, hey, you know what? It's been a great run. Maybe we should kind of be a little bit more conservative.
The great news is people are cautious and they are a bit nervous and anxious about this rally. To your point, when the TMT bubble bursted, it was more like, how could we be so dumb? We're in a new paradigm. How can you not own stocks? How can you not own Pets.com? That's everything. We're not in that scenario. So, in fact, it gives me greater conviction that this rally has room to continue from that perspective. I often talk to clients and investors. If your client is calling you and telling you on the phone, why don't we own more? Why don't we buy more? That's the time to be nervous. In fact, Tom, what they're doing is they're calling and they're nervous, they're anxious. That's probably a healthy skepticism for this rally.